This chapter presents standard material, defining what money is and explaining how the process of money supply works. It is an introduction to the monetary system, providing the foundation for understanding monetary policy. So, in this chapter, you'll learn the definition, functions, and types of money, how banks create money, and what a central bank is, and how it controls the money supply. We now begin our analysis of monetary policy by first defining money. Basically, money is the stock of assets that can be readily used to make transactions. So, roughly speaking, the dollar in the hands of public consists the economy's stock of money. Money has three main purposes or functions. First is medium of exchange, that is, we use it to buy stuff. Second function is store of value function, that is, it transfers purchasing power from the present to the future. And third is the unit of account function, that is, the common unit by which everyone measures prices and values. There are two types of money. One, fiat money. Two, commodity money. Fiat money, created by government decree, has no intrinsic value. For example, the paper currency we use. On the other hand, commodity money has intrinsic value. For example, gold coins. Why? Because gold can be used for dental fillings, jewelry, and so on. Therefore, it has intrinsic value. Another example of commodity money is cigarettes in POW camps. In prisoner of war camp during World War II, cigarettes emerged as a form of commodity money. That is, prisoners used cigarettes to trade the goods they received in Red Cross parcels because this eliminated the need for a coincidence of wants before trade could take place. Fiat money can be emerged or instituted as a natural evolution from commodity money. For example, 1. If gold is serving as a commodity money initially, then the government can step in and mint gold coins that are of a specified and guaranteed purity and weight. Second, then, the government can issue the promissory notes backed by gold. And finally, third, once everyone is willing to accept them, there's no need for it to be backed by gold anymore. Now you try to answer these questions. Which of these are money? Let's start with currency. Is currency money? Yeah, it is the money. That's pretty obvious. And second, checks. Are checks money? It's pretty confusing. The answer is no. Not the checks themselves. However, the funds in the checking accounts are money. So C, is deposits in checking accounts money, also known as demand deposits? The answer already is given to you, yes. And D, credit cards. Are credit cards money? Well, the answer is no. Why? Because it's a means of deferring payment, but it's not a money. And finally, certificate of deposits, also known as time deposits. Let me answer for you. CDs or time deposits are a store of value and they are measured in money units. However, they are not readily spendable. Why? Because you have to pay early withdrawal penalty. So in the narrow sense, very narrow sense, it doesn't seem like a money. On the other hand, in the broader sense, however, they can be considered as money. Now let's start discussing about the money supply and the monetary policy definitions. First, the money supply is defined as the quantity of money available in the economy. And monetary policy is the control over the money supply. And the monetary policy is conducted by a country's central bank. Sometimes central bank is just a branch of the government, but in other cases it is partially independent of the political system. For example, the Fed in the United States. As you probably know, the US central bank is called the Federal Reserve or the Fed. To control the money supply, the Fed uses open market operations, that is the purchase and sale of government bonds. For example, if the Fed wants to increase money supply, then they do that by bond purchase. On the other hand, if they want to decrease money supply in the system, then they try to do that by selling bonds. These are known as open market operations, the purchase and sale of government bonds. So how would the quantity of money be measured? There are several different money supply measures. The most liquid asset, first, is the currency, that is bills and coins. Then, M1. So M1 consists of the currency and demand deposits, traveler's checks, and other checkable deposits. M1 is known as narrow money. Then third, M2. M2 is known as broad money, and M2 consists of all of the things in the M1 plus retail money market mutual fund balances, saving deposits including money market deposit accounts, and small time deposits also known as CDs. The definition of the money supply that we use in macroeconomics in general is currency plus demand deposits. And since the money supply includes demand deposits, the banking system plays an important role. Before we delve into the main parts, let's learn a few preliminaries. First, reserves. It is the portion of deposits that banks have not lent out. And a bank's liabilities include deposits, and assets include reserves and outstanding loans. Next, 100% reserve banking. So the 100% reserve banking is a system in which banks hold all deposits as reserves. In this case, the banking system does not affect the money supply. On the other hand, the fractional reserve banking is a system where banks hold a fraction of their deposits as reserves. In this system, banks create money. In order to understand the role of banks, we will consider three scenarios. The three scenarios are, first, no bank scenario. The second, the 100% reserve banking scenario, that is, banks hold all of the deposits as reserves. And third, fractional reserve banking scenario, where banks hold a fraction of deposits as reserves, use the rest to make loans. In each of the three scenarios, we assume C, currency, equals to $1,000. Let's start with the first scenario. No banks. With no banks, demand deposit equals 0. And because money supply equals to currency plus demand deposits, that is M equals C plus D, when D equals 0, then M equals C, which is $1,000. Therefore, with no banks, M equals $1,000. That is same as the amount of currency. In this case, there's no impact on the size of the money supply. Next is the 100% reserve banking scenario. So initially, C equals 1,000, D equals 0, therefore C plus D equals 1,000. That is M equals 1,000. Now suppose households deposit the $1,000 at First Bank. So after the deposit, currency equals 0, demand deposit equals 1,000. Therefore, money supply equals C plus D equals 1,000. So the lesson is that in the 100% reserve banking system, there's no impact on size of the money supply. Finally, the third scenario, that is fractional reserve banking scenario. Suppose banks hold 20% of deposit in reserves, making loans with the rest. And the first bank will make $800 in loans with a 20% requirement to hold reserves. So in this case, so-called reserve deposit ratio, that is, reserve over deposit, should equal to 0.2. So out of 1,000, you have to keep $200. That is 1,000 times 0.2 as reserve. That means you can lend out 0.8 times 1,000, which is 800. So for this case, now the money supply equals 1,800. That is, depositor has $1,000 in demand deposits, and the borrower holds $800 in currency. So M equals to C plus D equals to C equals 800, D equals 1,000. Therefore, M equals to 800 plus 1,000 equals to $1,800. So what's the lesson? In a fractional reserve banking system, because banks lend money, the process of lending money, through the process, banks create money. Now suppose the borrower deposits $800 in the second bank. Or maybe the borrower uses the money to buy something from someone else, who then deposits it in the second bank. Then initially, second bank's balance sheet is deposit 800, reserves 800, loan 0. Then second bank will loan 80% of this deposit, that is 0.8 times 800, that is $640. Then the balance sheet looks like this. So in this case, the $800 finds its way back into the banking system. And if this $640 is eventually deposited in third bank, then the third bank will keep 20% of it in reserve and loan the rest out. And so on and so on and on and on. So the total money supply equals to the original deposit of $1,000 plus first bank lending of $800 plus second bank lending of $640 plus third bank's lending of $512 plus other lendings, on and on, ad infinitum. And then the total money supply should equal to, using geometric series, I can show the work. So at the end, you can derive this formula. The total money supply should equal to 1 over reserve deposit ratio. So if the reserve deposit ratio is 0.2, then 1 over 0.2 times 1,000, the initial deposit or original deposit. So in our example, the reserve deposit ratio equals 0.2, so the total money supply should equal to 1 over 0.2, which is 5, times initial $1,000 deposit. So 5 times 1,000 equals to 5,000. So that will be the total money supply. Just a note, a fractional reserve banking system creates money. However, it does not create wealth. Why? Because bank loans give borrowers some new money and an equal amount of new debt. Therefore, a fractional reserve banking system creates money, but it does not create wealth. Now, I want to introduce the bank capital. That is, the resources a bank's owners have put into the bank to get the business going when they started. That is, the equity of the bank's owners. Therefore, after introducing this, a more realistic balance sheet looks like this. That is, in the assets section, you might have, in addition to reserves and loans, actually there are securities. For example, government and corporate bonds. On the other hand, on the liabilities and owner's equity section, that is right-hand side of the T-bar, or T account, in addition to just deposits, then there's capital, that is owner's equity, that is bank capital. In addition, they also have debts, that is, they also borrow to run their business. So a bank uses a strategy of leverage to augment or supplement its capital for the purpose of investment. That is, it borrows money through deposits and debts to increase the resources available for investment. And the leverage ratio, which is equal to assets over capital. So in this case, assets include both reserves and loans, in addition the securities. So 200 reserves plus 500 loans plus 300 of securities divided by $50, that is capital or owner's equity. So the leverage ratio, that is the ratio of total assets to bank capital, in this case equals to 20. So this means for every dollar of capital the bank owners have contributed, the bank has $20 of assets and $19 of deposits and debts. So the leverage, that is the use of borrowed money to supplement existing funds for purposes of investment, is very important to understand the banking system. So being highly leveraged makes the banks vulnerable. For example, suppose a recession causes our bank's assets to fall by 5%, that is to $950. Then capital equals assets minus liabilities should equal to 950 minus 950 equals 0. In other words, the capital of bank's owners wiped out. And if that happens, the concern that bank capital is running short may lead depositors to demand their money, and in the absence of deposit insurance, may cause so-called a bank run. Therefore, bank regulators require banks to hold sufficient fund as capital under what are known as capital requirement. They are minimum amount of capital mandated by regulators intended to ensure banks to be able to pay off depositors, and they are higher for banks that hold more risky assets. So that is putting a ceiling on bank leverage ratios. And during 2008-2009 financial crisis, losses on mortgage shrank bank capital. So in other words, we had so-called subprime mortgage crisis, and it slowed lending and exacerbated the recession. So the government injected billions of capital into banks to ease the crisis and encourage more lending. Now, we want to analyze how the central bank influences money supply with a model of money supply in a fractional reserve banking system. Let's begin this by introducing so-called exogenous variables of this model. First exogenous variable of the model is the monetary base. Let's denote it as B. And B equals to C plus R, where C is the currency and R is the reserve. And so the monetary base is defined as the total number of dollars held by the public as currency and by the banks as reserves. And this is directly controlled by the central bank. The second exogenous variable is the reserve deposit ratio. Let's denote it as lowercase rr, and that should be equal to reserve over deposits, which means the fraction of reserve as a share of demand deposits. So this reserve deposit ratio depends on, first, regulations, and second, banks' policies. Finally, the third exogenous variable I want to introduce in this new model is so-called currency deposit ratio. Let's denote it as lowercase cr, and that's equal to the amount of currency C that people hold as a fraction of their holdings of demand deposit D. So C over D. And it depends on household preferences. So starting with M equals C plus D, the equation I already mentioned before, let's manipulate the equation to derive this new equation. That is, the multiply capital letter M should equal to, at the end, lowercase m, which is known as money multiplier, times B, the monetary base, where after all these manipulation of equations, the lowercase m, the money multiplier, should equal to currency deposit ratio, CR, that is, plus 1 over CR plus RR, the reserve deposit ratio. So the point of this algebra is to express the money supply in terms of the three exogenous variables that I introduced in previous slide. That is B, RR, and CR, where B is equal to C plus R, and RR equals to R over D, and CR equals to C over D. So you want to write this down in a piece of paper. So this equation shows how the money supply depends on the three exogenous variables. That is, money supply equals to lowercase m, which is equal to CR plus 1 over CR plus RR, times B, the monetary base. So money supply M, capital letter M, equals to the money multiplier lowercase m times the monetary base B, where lowercase m equals to currency deposit ratio plus 1 all over currency deposit ratio plus reserve deposit ratio. So you expressed the money supply as a function of these three exogenous variables. So once you know what happened to these exogenous variables, you can figure out what's going to happen to the money supply. For example, if reserve deposit ratio RR is less than 1, then you would know that money multiplier should be greater than 1. Why? Because the denominator gets smaller than numerator, therefore the lowercase m gets larger than 1. And if its monetary base changes by, let's use change in B, some number, then change in money supply should equal to the money multiplier m times the changes in B, monetary base. So let's say if monetary base increases by a certain amount, then money supply should increase by m times that amount of change in monetary base. So, like I said, lowercase letter m is the money multiplier, and that depicts the increase in the money supply resulting from a $1 increase in the monetary base. So, if you understand what affects money multiplier in what way, then you can understand what's going to happen to money supply as well. For example, let's say if CR decreases, then this would increase money multiplier and therefore increase money supply. Another example, if RR decreases, and this will increase money multiplier, therefore increase money supply. And finally, if B increases, this will increase money supply. So, with this equation in hand, then you can figure out, let's say as a central banker, you wanted to increase money supply, do you understand what the central bank could change to increase money supply? If the central banker could induce the banks to hold less reserves, so therefore lower RR, then you can increase money multiplier, therefore increase money supply. And second, if the central bank increases monetary base, then you can also increase money supply. But note that so-called currency deposit ratio is not directly controlled by the central banker, which is affected by the decision of the households. Therefore, you can just predict what happens if households decide to hold less currency relative to deposits, or more currency relative to deposits. And if they figure out the households hold less currency relative to deposits, then you can figure out this will increase money multiplier and therefore increase money supply. On the other hand, if for some reason household wanted to hold more currency versus deposits, then this would lower money multiplier, therefore lower money supply. With the same reasoning, if for some reason the bankers hold less reserve relative to deposits, then you can see the money multiplier would increase, therefore increase money supply. On the other hand, if for some reason, if the bankers hold more reserve relative to deposits, then this will induce, that is, in this case, decrease money multiplier, therefore decrease money supply. Now, why don't you take a moment and try to answer this question. Suppose the households decide to hold more of their money as currency and less in the form of demand deposits. Then try to answer this question. 1. Determine the impact on money supply, and then try to explain the intuition for your result. So let's take a moment to answer this question. The key is to use the equation that's given or derived and figure out what this means first by having household deciding to hold more of their money as currency and less in the form of demand deposits. In other words, what would get affected by this? Is it going to be affecting CR or RR or B first? Then figure out what that effect has on either M or B, therefore money supply. So why don't you take like a minute to think about it and write this down on a piece of paper. What would this change? So it's important to remember the definition of CR, RR. So CR is equal to C over D, for example. RR equals to reserve R over D, etc. So assuming you already went through this, let me give you the answer. So when you say suppose the household decide to hold more of their money as currency and less in the form of demand deposits, that means currency C increase while D, demand deposit D decrease. Therefore, it affects currency deposit ratio CR to go up. So the impact of an increase in the currency deposit ratio is the change in CR is greater than 0. It increases CR. So once you know that increase in CR, then you know that it affects the denominator proportionally more than the numerator. So the money multiplier actually falls. So increase in CR would decrease money multiplier, therefore causing money supply to fall. So the intuition is this: if households deposit less of their money, then banks cannot make as many loans, so the banking system would not be able to create as much money. Now let's look at the instruments of monetary policy based on the model we just derived. First, the Fed can change the monetary base using two means. First, the open market operations. That is the Fed's preferred method of monetary control. And if the Fed wants to increase the monetary base, the Fed could buy government bonds, paying with new dollars. The second method to achieve this is using the discount window, or affecting the discount rate, that is the interest rate the Fed charges on loans to banks. To increase the base, the Fed could lower the discount rate. This will lower the cost of borrowing and therefore encourage the banks to borrow more reserves. Next, the Fed can change the reserve deposit ratio using, first, reserve requirements, that is, the Fed regulations that impose a minimum reserve deposit ratio. So in order to reduce the reserve deposit ratio, the Fed could reduce reserve requirements. So this will lead to increased money multiplier, therefore increasing money supply. And finally, interest on reserves. That is, the Fed pays interest on bank reserve deposit with the Federal Reserve. So if they want to reduce the reserve deposit ratio, the Federal Reserve could pay a lower interest rate on reserves. And when you lower the interest rate on reserves, this will lower the amount of reserves, therefore lower the reserve deposit ratio, and increase money multiplier, therefore increase money supply. Despite the Fed's effort to control money supply, the Fed cannot precisely control money supply because, one, households can change currency deposit ratio, causing money multiplier, therefore money supply to change. And second, banks often hold excess reserves, that is, reserves above the reserve requirement. And if banks change their excess reserves, then this ratio could change, reserve deposit ratio could change, therefore money multiplier, and therefore money supply to change. So probably this is what happened right after the 2008-2009 crisis. They decided probably to hold excess amount of reserve because suddenly banks became more risk averse. As you see in this plot, the monetary base grew rather gradually over time from 1960 until 2007. But then from 2007 to 2014, it spiked up about fivefold. This is due to the so-called quantitative easing. The quantitative easing is one of the unconventional operations by the Fed during the recent crisis. Quantitative easing is a kind of open market operation where the Fed bought long-term government bonds instead of treasury bills, very short-term bonds, to reduce long-term rates. The Fed also bought mortgage-backed securities to help the housing market. But after losses on bad loans, banks tightened lending standards and increased excess reserves, causing money multiplier to fall. So within our modeling framework, when reserve deposit ratio increases, in this case, it reduces money multiplier, therefore reduces money supply. However, if banks start lending more as the economy recovers, rapid money growth may cause inflation. So in order to prevent, the Fed considered various exit strategies. For example, selling treasury bonds and other securities in the Fed's portfolio. Another example of exit strategy would be increasing the interest rate it pays on reserves, leading to holding reserves become more profitable for banks and discourage bank lending and keep the money multiplier low. These are examples of exit strategies. Now let's look at a case study, the bank failures in the 1930s. So from 1929 to 1933, over 9,000 banks closed and money supply fell 28%. This drop in money supply may not have caused the Great Depression, but certainly contributed to this severity. I highly recommend you to watch the Free to Choose episode number 3, The Anatomy of Crisis by Milton Friedman, that I posted the link to the YouTube video. So now let's use the models we just learned to analyze bank failures in the 1930s. So there's two effects. That is, loss of confidence in banks by households. This has changed the household behavior by increasing the holdings of cash or currency and decrease the amount of demand deposits. So this led to the increase in the currency deposit ratio CR. So when CR increases, it decreases money multiplier M. At the same time, banks became more cautious as well. This has induced the banks to hold excess amount of reserves relative to deposits. So this would increase the reserve deposit ratio RR, therefore would decrease money multiplier M. So both households loss of confidence in banks and banks becoming more risk averse and being cautious to lend combined lowered the money multipliers significantly. Therefore, has a high effect in decreasing money supply. And let's look at the data in the next slide. This is a table based on the data from Milton Friedman and Anna Schwartz of 1963 publication and retrieved from Appendix A and calculated based on the data. So we have two columns, that is August 1929 and March 1933, and then last column is the percent change of these variables that are, first row, the money supply, which is equal to C plus D, second row plus third row. And then fourth row is B monetary base, which is equal to C plus R, which is sum of the fifth and sixth row. And then seventh row is the money multiplier, which is calculation based on RR and CR. There are 8th and 9th row. So here, as you want to focus on money supply changes and monetary base changes and money multiplier changes. So what happened was the excess amount of reserve they hold and the excess amount of cash they want to hold, households want to hold, lead to fall in money multiplier significantly. How much it fell from August 1929 to March 1933 is given by the last column and the seventh row. That is, the percent change in money multiplier is approximately equal to 37.8% decrease. Negative 30.78% means decrease. And correspondingly, if you look at the first row, the money supply decreased by 28.3%. So here the fall in money supply is due to fall in the money multiplier. So if you look at the fourth row, that is the monetary base changes. If you look at it, in fact, monetary base actually increased by 18.3%, but it was not sufficient enough to cover huge drop in money multiplier. And as Milton Friedman's data shows, the Fed should have increased the monetary base even further to offset the fall in the money multiplier. In other words, they didn't increase enough of monetary base to mitigate the effect in the fall in money multiplier to keep money supply constant. So in order to prevent a sudden large decline in the money multiplier that may lead to bank run, many policies have been implemented since 1930s to prevent it. For example, the FDIC, the Federal Deposit Insurance Corporation, was instituted by the Banking Act of 1933, which also separated banking and securities industries. This is also known as Glass-Steagall Act. So the FDIC, or Federal Deposit Insurance Corporation, was instituted to prevent bank runs and large swings in the currency deposit ratio. However, during 2008 and 2009 financial crisis, when the FDIC guaranteed protection was $100,000, many bank customers deposited their money into one bank. They probably could not believe this could happen, but then actually things happen. For example, IndyMac Bank case. So the customers who deposited their money in one bank was running to the bank when they heard the news that Intimate Bank was insolvent. And I remember on TV, people lined up and one of the old lady was crying because she put all her life savings into Intimate Bank because they guaranteed higher interest. But then now she's in a danger of losing most of her money. You can imagine how bad it is. At the time, FDIC guaranteed protection was only $100,000. And she was probably crying because she had to live off that $100,000. That would not be enough for her survival. So since these incidences, actually, they raised the guaranteed protection to $250,000. So if you are a person with $1 million, then if you divide your $1 million into 4 different banks to deposit, then you have guaranteed all $1 million protection. So this would reduce significantly the likelihood of bank runs because people would trust more in the banking system than before. So could this incident happen again? Of course, history repeats when people forget the history. But this institution has reduced the likelihood of these instances. Now this completes chapter 4. So what's coming up next? In chapter 5, we'll learn the classical theory of inflation. So here, when we say classical, we assume prices are flexible and markets clear, and it applies to long run. So chapter 5's model is a long run model. So in chapter 5, we'll learn the quantity theory of money and social cost of inflation, and finally classical dichotomy and neutrality of money. As the title implies, we learn about the theory about inflation, its causes, effects, and social costs. This will be an interesting chapter, but a very demanding chapter. So be ready for it.